There's one more specific question I want to talk to you or ask you about, and that's your time when you're at Platinum during the GFC. And I think it's because it's the most recent. It's a good opportunity to talk about some of the lessons learned in a downturn, and I suppose how your process and your thinking has evolved from any of those experiences. So if you could share any of those, that would be fantastic.
Yeah, I mean, there's a generation of investors, I think, you know, have been sort of somewhat scarred by the GFC, and like Platinum and myself got through the GFC in pretty good shape. So you know, we had good downside protection. By that stage, I was working primarily on North American. I'd sort of started on global sectors. I had some time covering Indian, as a country, India as a country, and then was, focused more broadly on North America. And so, we had decent short protection. We shorted some of the very weaker REITs, and we knew they'd been very dependent on what was going on in credit markets, and some of them were just taking on too much leverage. And what we learnt, or what prepared us well, I think, for what happened or what was happening in the GFC was probably the 10 years prior to that, where let's call it, for me, 8 years, but leading up to the GFC, just working on different industries and just looking at how credit markets were evolving, and just the simple observation that loan origination, like the credit assessment and the ownership, had been unbundled through innovation. And then, we then fully understood that the CDOs were then allowing the market to, really bundle quite very low quality exposures and, into AAA rated paper. And so it wasn't, we weren't sitting there going, oh, wow, what's going on? We actually knew what was going on.
Oh, so you could see it?
Yeah, we could see it. We were eyes wide open.
Okay. And
which had made us quite, we weren't exposed to US financials, and we had fairly moderate exposure to financials anywhere in the world. And we had significant, let's call it shorts that were very much credit market sensitive in the book, and they gave us the protection. But, what you don't want all your alpha to come from one macro event, right? So I think the lesson for me as an investor was, well, that's great. You've got to think about those tail risks and how to protect investors when they become real, and when you start unless you're thinking and doing the research in a sort of a proactive way, you're not going to be ready. But you also got to think about, well, what matters over the long term, right? What matters over the long term is being long, interesting companies, great companies, generally in areas of the market that are growing, generally, and in backing management teams that can execute well, and businesses that inherently have barriers to entry, and can protect their position. And those companies are rare. Right, so you've got to have, as an investor, appropriate focus. 80% of your time should be spent on identifying those companies. 20% thinking about macro and tail risk. Absolutely. If you keep that balance, I think it will stop you being, too macro at the wrong time. Because it's often the right time to be investing, right? When a lot of these things are
flashing red. Yeah, absolutely. And that's an interesting way to quantify. I've never heard anyone put it like that. We always talk about bottom up and top down. Think about it in terms of 80-20. It's an interesting one.